Is it perhaps that even though we did get the tweak that the market was looking for, in terms of its impact, it's not going to be as durable as people were hoping for, namely because it is still just a tweak. They're not abolishing the YCC policy in full.
Yeah, so I think, to be fair, I think the market is partly surprised. It wasn't something fully expected for this year. I would say for this meeting, it was mostly 50-50 in the market's mind. So I think there is a bit of kind of assessment going on by the market and figuring out how far this is going to go. And so positions are being adjusted, and that has effects on effects. So I think there's a lot of noise right now. Volatility is going to be very high. But if we look a little further out, we think this is quite significant. This is a move towards normalization, and that is not really going to reverse given the backdrop of inflation at the global level. This is what's different. Japan, to generate inflation on its own when everything else was disinflating around the world, was a very tall order. Japan being able to sustain, let's say, close to 2% when the rest of the world is now in a much more balanced inflation backdrop is much more plausible, and that means that BOJ policy really needs to adjust to that.
What do you think the ramifications are in the rest of the world, though? Because Bank of Japan have been, or Japanese investors have been very strong buyers of U.S. Treasuries. If their own domestic yield is moving higher, then that makes the relative attraction of U.S. yields less of a concern for them. So what do you think it does to fixed income globally?
Absolutely. So global rates markets need to factor this in, and it would be primarily through the term premium, which has been very depressed as a result of this ongoing YCC and quantitative easing happening in Japan that depresses term premium way beyond where they would be otherwise. And so this is the last man standing in terms of doing QE, and they're actually in the process of withdrawal, which means that there's an incremental upward bias towards rates at the long end of G10 curves.
What's your top trade for the second half of this year?
We would say Chinese equities remain the place to be in terms of your equity allocation, and that's unchanged, and we're seeing very good follow through in terms of the policy direction that will create a tailwind for that market. But we also like credit in Asia as well. Given this supportive growth backdrop in China, and given
high yield or quality?
I would say both, but high yield's quite interesting given that we're talking double-digit yields with very low duration. So you're not actually taking a lot of interest rate risk. If you can do good credit work, you need credit selection, but there's very attractive yields on offer.